Please subscribe, like, and hit that notification bell. Thanks, guys. All right, guys. Look, this is the way you got to start measuring U.S. equities. U.S. equities, they, in nominal value, might give the appearance that they're not doing so good or better than they are. But when you measure them in something else like gold, silver, producer price index, inflation, or oil, then you get a different picture. And you get this picture is twofold. It tells you in what type of environment you are. So if oil is outperforming the SPX, then you know that you're opening the gateways for growth stocks that have a harder time, and you're opening the gateways for gold, silver, copper, commodities, anything that's real, drop on your foot, that hurts, to appreciate in value. And that's another piece of evidence. And often we've done the SPX divided by PPI, which shows this clearly. But look, this is one because Kevin Wadsworth there, my partner, North Star Charts, he did one was SPX divided by XLE. So that was the S&P SPX sector for oil explorers, I think, in the whole sector. And it was clear breakdown. And I said, man, look, let's see oil, because the US oil ticker in TradingView gets me data going all the way back to 1881. So, okay, I'll just show you this chart, guys. This is not going to be long, but you have to understand what's happening right here. So right here, as it's going up, that's US equities outperforming oil. So oil is probably not moving that much. US equities are outperforming it until they've outperformed oil too much. Then after that, they finish their minor cycle upwards, break down, and then they go in sleep mode versus oil until they reach a bottom, which is a good retrace from that move up, but it's a higher low right here. And that we're starting to trace what's going to be what I call a major cycle after that. So up it goes. Now this is the bull run from 1945 all the way to 1968, and then it tops, and then in 1970, 72 it breaks down. Total breakdown, right? Because it broke down from this rising trend line, which is the second minor cycle in that bigger major cycle, breaks down, tries to go back up. But priced in oil, even if US equities managed to do marginal higher high in the late 60s, cannot do a new high when measured in oil. And because you're below that minor cycle trendline break, it's over. And this is the classic move. The echo bubble can't go back above previous highs on the wrong side of that minor cycle trend line. And that's all she wrote. And that move led to a fast and furious drop, which completed this major cycle, broke through it like butter, and just went down and down and down. From that point here on the echo bubble, I didn't even measure here from the top there, just from that small peak right here, US equities went down. They underperformed, went down 90%, over 90% when measured in oil. So let that sink in there. The ratio went from log scale, so maybe 38 to 1. So whatever SPX was at that moment, it was 38 times more expensive than oil for 1 unit of oil. And by the time it was over, it was 3, even lower, guys. Look, 2.6, 3. I put that line to 3. So whatever oil was priced back here in the late 80s, late 70s, then SPX was barely 3 times that amount. So that was the end of the major cycle. The target was the previous lows, or that section, that zone right here. Because remember, you go high, here's a neckline also, reverse symmetry moves, and then you have a neckline here. If it breaks down, reverse symmetry move. This is classical human psychology seen through the charts, just repeating over and over. So now we're starting a new cycle in favor of US equities outperforming oil. And oil, and this is charts that I've done for our members at North Star Buy Charts. I've showcased that why there's a big paradigm shift in 1973. So as oil now, as SPX outperforms oil, once it breaks down, same thing, echo bubble up, can't get as high, and just falters. And that was the first minor cycle, a long one, in favor of US equities that broke down. goes down, 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 then starts. This is the end of the warm-up, just like here in 1929, 1949 was a warm-up in favor of oil. This was a warm-up in favor of oil as oil was outperforming SPX. That ratio was going down. What do we do? That minor cycle created a higher low, which is going to be the setup for the final breakdown of that major cycle. We go up high, even here in the 60s, late 60s went higher high than the first minor cycle, higher high than the first minor cycle. And 1, 2, 3, 4, 5, breakdown, total breakdown, clear. Now what's happening is it's the echo bubble right here. And we're going to see, look, unless the echo bubble does a new high or goes above this minor cycle breakdown line, that's on an occasion to go long oil in favor of SPX. And this is what I told our members at NorthStarBatCharts.com, and there's charts to showcase this. After 1973, oil is inversely, majorly correlated to this chart. So this price action moving here is because oil is driving it. So if this goes down, it's because oil is going up more than because the SPX is going down or sideways or going up. So often in ratios, the ratio could go down, but both instruments could be going down. It's just that one's going down less fast than the other. Ratio could go up, but both instruments could be going up, just one less fast than the other, or just one going one direction, the other one going the other direction. But in this case, and the charts are on our website, this is majorly oil driving this. And that started since 1973. Contrary to the previous section here, where it was majorly the SPX driving this ratio chart, positively driving this ratio chart. So here's the target. So here's going to be a reverse symmetry move that's going to play out all the way to this neckline to a ratio of about 15 to 1. Just like it did in the 60s, in the 70s when it broke down, and then after 1974 it hit that support. So we're going to have a move down. It's going to break down through this major cycle breakdown line, hit that support, maybe bounce back up. I don't know how high. Here in the 60s, here it bounced. You see around that region, it bounced a little up. So maybe in 2024, 2026, I don't know when that's going to happen. But after that, it's going to continue one more leg down. And then it's going to go reach its target of 3 to 1. And then when everybody thinks it's death of U.S. equities, it's the oil is going to go to 3,000, 2,000, whatever the dollar amounts because is going to be, that's when it's going to be over for oil, and then you'll have to flip out. Because look, I'm just going to run some numbers by you. 3. So the target is 3. So let's say SPX goes down to 2,000. That means oil is going to be $666 at peak. So peak priced oil is going to be $666 a barrel if SPX is at 2,000. If SPX is at 4,000 in the 2032 or 2030, whenever we hit this bottom rail, then oil is going to be at above 1,300, right? It'll be 666 times 2 to keep that ratio. Those are astronomical numbers, man. Like, you can't even fathom those numbers until you see this ratio chart. Oil could be low. Let's say SPX goes down to 900, then oil will only be 300 because 3 to 1 ratio. If SPX is 900, then oil is going to be 300. So even if there's a deflation in SPX, US equities stock price, oil will still do very well compared to what it is today, guys, because that will be a $300 target for oil. This is the era of oil, of energy. It's the era of silver, of gold. It's happening now. The minor cycle has broken down. Yes, it could reflate up here, but with all the other evidence, guys, that I've shown you, this is slowing down. And here, I'm just going to show you one more chart that I replied. Somebody says, so everyone loses, why buy miners then? Because I'm saying US equities are going to underperform oil. Well, this is a thing, because when I say US equities, I'm talking about the SPX, right? But the nuance is the SPX is majority at 95%, because if I remove materials, 2.6%, which is commodities, like hard assets, all stuff like that, and energy, oil, it's only for less than 5% of the total weight of the index. That is not So even if I'm telling you oil is going to go to the moon, outperform SPX, it's not going to change much the SPX. I'm not going to keep the index afloat. It's not enough, because you'll see the index is a whole bunch of other stuff that is not. It's financials, technology, healthcare. It's not oil. It's not natural gas. It's not uranium. It's not gold. It's not silver. It's none of that. So, and it's not the miners. And that's coming back to the question. So the miners, they're not going to they could go up drastically while the SPX goes down, because the miners going up will not drag down the SPX. And that's it, guys. I hope this makes sense, but get ready for a huge depreciation of the SPX when measuring oil to the 90% move down, guys. It's going to be horrific. All right, guys. Thanks for watching. Please subscribe, like, and hit that notification bell. Thanks, guys.